Hi everybody, welcome back to Chapter 9 series of video lectures. In the next few video lectures, we'll talk about short-term notes payable. Let's define it first, then we'll take a few lectures to work through a pretty good sized problem. Short-term notes payable are formal, written promises to pay specified amounts on stated future dates within 1 year. Most notes bear interest, and they may arise from an overdue accounts payable or from borrowings from a bank. We are going to be working problem 9-1B on page 372 of your textbook. I have duplicated virtually all the important information here, so you can certainly open your textbook to that page if you want, but you probably don't need to. I have uploaded this worksheet in both a PDF format and an Excel version, and you should download either the PDF or the Excel version so that you can work along with the video and solve the demonstration problem as we go through the next 2 or 3 videos. Warner Company entered into the following transactions involving short-term liabilities. On April 22nd, they purchased $5,000 of merchandise on credit from Fox Pro, terms net 30. When May 22nd came along, they found that they could not actually pay the bill, and so they contacted Fox Pro and arranged to replace that accounts payable with a note payable. They did pay $400 down on the account and signed a 60-day 15% note for the $4,600 balance left. On July 15th, they borrowed $12,000 cash from Spring Bank by signing a 120-day 10% $12,000 note payable. We're going to figure out the maturity date of the Fox Pro note, but they paid that balance due at maturity. They also paid the balance due on the Spring Bank note at maturity. Then on December 6th, they borrowed $8,000 cash from Citibank by signing a 45-day 9% $8,000 note payable. On December 31st, we have to accrue the interest expense on the Citibank note payable. In year 2, at the maturity date, they paid the balance due on the Citibank note. So the first thing you need to do is to be able to determine the maturity date of a note. And we have 3 opportunities here. So step 1. Determine the maturity date of the Fox Pro note. I have given you the number of days in each of the months in the year, so you don't have to worry about does October have 30 or 31 days. I've got it here for you. It's got 31 days. So let's figure out how we will go about finding the maturity date of this note. Well, we're going to start counting the days that we've used the $4,600 of Fox Pro's money. May has 31 days. We signed the note on May 23rd. So for the month of May, we borrowed that money for 8 days. June has 30 days, so between May and June, we use that money for 38 days. This is a 60-day note, and we're getting close. So 60 days minus 38 days through the end of June means there's 22 more days. So the maturity date of this note is July 22nd. And that gets us up to the full 60 days. So maturity date is July 22nd. So let's put that in up here. Let's do another one together, and then I'll have you do the last one by yourself. Determine the maturity date for the Spring Bank note. We borrowed $12,000 from Spring Bank on July 15th. We signed a 120-day, 10% $12,000 note. So we want to be able to count out 120 days from July 15th, and that will be the maturity date. We borrowed the money on July 15th. July has 31 days in that month. 31 minus 15 means we used the bank's money for 16 days in July, plus 31 days in August, not even close to 120 yet, plus 30 days in September, still not close to 120 yet, plus 31 days in October. Now we're getting kind of close to 120 days. 120 minus the $108 cumulative days through October 31st means we need 12 additional days. So the maturity date of this note is November 12th, and that then gives us the full 120 days. So I want you to find the maturity date of the Citibank note. Follow the same method. We borrowed $8,000 cash from Citibank by signing a 45-day 9% $8,000 note payable on December 6th. You go ahead and find that, pause your video. When you have done that calculation, come back and check to see if you got your answer correct. For the month of December, there's 31 days. We borrowed the money on the 6th. 31 minus 6 is 25 days in December, plus an additional 20 days in January. Gets that to a 45-day on the note payable. So the maturity date is January 20th. So let's fill in January 20th here. Okay, there's a lot more to do with this problem. When we come back on the next video, we'll work some more of this problem.